What's going on, everybody? It is Tuesday, October 17th. Flat market today. We were down initially because of a strong retail sales number. And then the market came back and rallied. And then we kind of closed unchanged on the day. I sent out an email to my subscribers during that rally saying, I don't think it's going to go anywhere. We're still in an environment, I'm pretty sure, which is a trading range, basically. The numbers are in from the tax drain, and yesterday's tax drain was a significant $71 billion. The government now has a surplus for the month of October of $36 billion, and that is a flip or a turnaround from a deficit of $39 billion just 2 days ago, where now the government's running a $36 billion surplus. Remember what a surplus is. A surplus is a subtraction from the financial balances of the non-government, of us, of the economy, okay? So, that's the swimming pool coming down. And if the government's running a surplus, it literally means like there's no water in the pool. I mean, there is water in the pool, but I mean, it has been sucked down pretty significantly. So we have to wait until those flows start to recover and we see that negative balance, on the non-government side. It's a positive balance on the government side. We have to wait till we see that negative balance go back to at least a break even or a positive balance. All right. Here's something you may be interested in is I was looking because I kind of forgot about this. It just was not on my mind, but I remembered now about the student loan payments. And I went to check, and sure enough, on the daily treasury statement, on the line item in the deposits part of the Treasury statement, Department of Education, this month alone, deposits were $3.6 billion. So I decided to see, if that was normal or not normal. How do you do that? I compared it with the same time last year, and sure enough, same time last year, when the government wasn't collecting student loan payments, deposits at the Department of Education were a mere $621 million. Now it's $3.6 billion. So far this month, and basically we've gone through half the month, we've seen a $3 billion flow to the Department of Education. In other words, that has been subtracted from the economy. Those represent student loan debt payments. So if I use that as a baseline, $3 billion, let's say in half a month, we're talking about $6 billion a month. That comes to like $72 billion annually of drain. I don't think that's big enough to have that much of a negative effect, to be honest, because, we ended last year with around a 1.7 trillion deficit. So, I mean, if you're going to take 72 billion off of there, that's not a lot. Like if you were to take, let's say, a few hundred billion, that's a different story. Like a few hundred billion, again, to use the swimming pool analogy, that's not a complete drain of the pool, but you would notice the water level being down a little bit, even if it was a few inches. Like, if anyone who has a swimming pool in their backyard, you got the skimmer, right? That filter, which it skims the water. You would see the water maybe go down to the lower edge of that skimmer, maybe even go below that skimmer. So that's something to keep an eye on. I mean, it's still too early. I mean, we're only into, today's October 17th. So, I mean, there's not enough data. You got to wait to see how the data develops, how the trend is. I mean, if I start seeing monthly these deficits really down compared to last year, that would be something. I mean, we don't want to see to explain this further, I would say, like, you don't want to see that swimming pool level come down, all right? Because it will affect economic growth, and that will affect the stock market. A small amount of subtraction is, we can handle that. And, I have to say that the interest income transfers, remember, the Fed is still operating on a longer, higher for longer program, which means that, they're going to keep rates. They may not cut rates, but they're going to keep rates elevated for a longer period of time. And that's just going to accrue, or it's going to add to these interest income transfers, because like I've been saying for the last year and a half, as these longer dated maturities, when they mature and they get rolled over, they're all going to get rolled over with the higher coupon or the higher interest rate. So those interest income transfers are just going to continue to go up. So I don't think 72 billion, if that's the number, I don't think that's going to have much of a negative effect, because it's going to be offset by the interest income transfers. But, the beauty of this is I see the numbers every single day. It's very easy to track and see what develops. And then you make a rational and scientific assessment. I mean, you got the data, you got the numbers. Like I say to people, it's not worth it to try to speculate in advance. Let the numbers tell you what's going on. And once you see a trend in place with these flows, you not only know what to do now, I mean, you know how things are going to play out 3 months, 6 months, a year down the road. So we got to see a little bit more of these numbers. Anyway, that was the stuff I saw so far on the student loan payments. So far, about $3 billion over last year, $3.6 billion for the month. And if you want to track these yourself, it's on the deposit table of the daily Treasury statement, and the line item is Department of Education. So you can follow that basically on a daily basis and see what's coming in. It would be interesting. I sent out an email, and it was like, people were like, Mike, what are you talking about? But anyway, I'm seeing a lot of these, the very serious people on Wall Street who, like, for the last year and a half, were telling us, screaming about how interest rates are going to cause a recession. And, it was universally believed at the end of last year, they were all saying that 2023, a recession is inevitable. I spoke about this many, many times in videos. I said they're all going to be wrong. I said as long as Congress raises the debt ceiling and spending continues as it had been, we're not going to have a recession. I mean, there's no way you're going to have a recession when they're spending $7 trillion annually, all right? And now what I'm seeing, so like all of these people, the big banks, Bank of America, JP Morgan, Morgan Stanley, all of them, they were all saying there's going to be a recession, there's going to be a recession. Now, what do you think they're all saying? And by the way, they were all bearish on the stock market. Remember this guy, Mike Wilson at Morgan Stanley? I talked about this guy quite a bit. I made videos about how, he just didn't understand. Like, he just, again, it's a single variable mentality. They look at interest rates. Basically, what it boils down to, folks, is that these people don't understand basic accounting. For every debit, there's a credit. For every liability, there's an asset. I mean, it's just like I've been saying. Yes, I mean, there are going to be people or entities that are going to be negatively affected by higher rates. But at the same time, there's an equal and opposite effect, that there's going to be people and entities and institutions that are going to benefit from higher rates. So, like I say all the time, the income doesn't fly out into outer space. It doesn't get burned up. It just gets redistributed in the economy. So anyway, what I was going to say is that all these people were telling us, how bearish the environment was and how it was unavoidable that we're going to have a recession in 2023. So now what do you think they're saying? Oh, we're not going to have a recession in 2023. The odds of a recession have gone way down. Of course, what do you think they're looking at? Number one, they're looking at, because they see everything through the lens of monetary policy. Number one, they're looking at the probability, the likelihood that the Fed has stopped raising rates, as if that is anything. Again, that's just a redistribution again, They stopped raising rates. So they completely ignore the fact that even though we had 11 or 12 rate hikes, whatever it is, taking the rate from like 0 basically to 5.5, in the most aggressive, rapid manner since the late 1970s, early 1980 with Volcker, despite the fact that we had that, and the market went way up, they don't see that. They can't connect the dots. Like, they don't understand that. Now they're saying, oh, it's great. We're not going to have a recession because the Fed is not going to raise rates anymore. And also because they're looking at the economic data now and saying, oh, everything looks good. Well, guess what? Everything looked bad at the time when, they were selling. And that was the time to buy. So I just think it would be fitting. I'm not saying we're going to have a recession, at least not right now. But in one sense, I would kind of love it. It sucks to have a recession. People lose their jobs and stuff like that. And again, I'm not hoping that it would happen. All I'm saying is that if it does happen, I would love it, because I love nothing more than to see these misinformed, closed-minded, stupid people get chopped up in the market. I mean, I just love that. And not because, I like to see people suffer, although I do like to see these people suffer, but because it's financial opportunity for me and for my subscribers. So, like, I would not mind. And I would probably, like most of the other things that I call, I would probably be the first one to call it out. Because right now they're all saying, no, everything's great and hunky-dory and the economy is just going to be fine and beautiful. But a year ago, they were saying how terrible it was going to be. It's awful. It's going to crash. It's going to go down another, 20, 30, 40%. I said, no, that's not going to happen. So we'll see. But as you know, I pretty much update you guys on this almost every day. Surely, my subscribers, they get emails multiple times during the day to either highlight or cite developments or just interesting things that expose the ignorance that is out there. And again, I've said many times, if you know nothing else but you go against emotion and ignorance, you're going to be fine. All right? Anyway, that's it for today, folks. Hope you're having a great day, and see everybody tomorrow. Don't forget to go to my website, pitbulleconomics.com. You could get the Understanding the Daily Treasury Statement video course. It's $99. I have MMT and value stock selection. If you want to learn how to select your own stocks, you don't need a stockbroker. I like selecting stocks. You don't have to. You could put your money in an index fund. It's fine, but I like the activity of selecting stocks, and that's a course. It's $99, and it's a course that shows you how to do that with an understanding of MMT. And then there's the Forex trading, 25-hour Forex video trading course. You get all three for $295. All right, that's it for today. Don't forget, MMT Trader. Got to have that report. All right, see you tomorrow. Bye.